Hey everyone, Andre Geek here. Today we're diving deep into crypto passive income. Imagine money working for you, not the other way around. That's the dream, right? Earning returns with minimal effort. Think of it like a rental property, but digital. This concept is incredibly appealing, especially in cryptocurrency. Many see crypto as the new frontier for financial freedom. The crypto space moves fast, it's exciting and a bit wild. The idea of earning passively here is powerful and draws people in. Traditional finance can feel slow and restrictive. Crypto offers innovation and new ways to grow wealth. Stories of big gains and early adopters fuel interest. The potential for high returns is a big hook. But it's not just about getting rich quick. For many, crypto passive income represents hope for a different financial future. A future with more control, where assets generate income even while you sleep. This is the core appeal: financial empowerment and leveraging new technology. The digital nature of crypto makes these passive streams possible. Things like staking or lending are built into the tech. But it's crucial to approach this with open eyes. The allure is strong, but the path is not always smooth. It's not a guaranteed ticket to riches. Understanding this from the start is key. We need to separate the hype from reality. We need to learn the fundamentals. This essay will explore that. We will look at the methods, we will look at the risks, and we will look at the potential rewards. So, let's get started. One of the biggest myths is that crypto passive income is easy money. You just click a few buttons and watch the riches roll in. If only it were that simple. The truth is, while the passive part means less active work, setting it up isn't effortless. It requires learning, understanding, and careful decision-making. Many platforms promise high returns, making it sound simple. But often, high returns come with high risks. This is a fundamental concept in investing, not just crypto. Another common misconception is that it's a get-rich-quick scheme. You hear stories of people making fortunes overnight. While some early investors did get lucky, that's not the norm. Sustainable passive income in crypto is built over time. It requires patience and a strategy. It's more like planting a tree than winning the lottery. Chasing quick riches often leads to quick losses, especially for newcomers. The market is volatile. Always remember that. Many also believe that all passive income methods are the same. This is far from true. Staking is different from yield farming. Lending has its own set of rules and risks. Each method has its own mechanics, potential rewards, and downsides. Thinking they are interchangeable is a mistake. It can lead to choosing a strategy that doesn't fit your risk tolerance or financial goals. Finally, some think passive income in crypto is risk-free. No investment is truly risk-free. Cryptocurrencies are inherently volatile. Prices can swing wildly, platforms can get hacked, regulations can change. These are all real risks. The passive nature doesn't eliminate these dangers. It simply means you're not actively trading day to day. Understanding these realities is the first step to making informed decisions and protecting your hard-earned capital. It's about being smart, not just optimistic. For beginners, the crypto world can feel like a maze. The biggest risk is often a lack of knowledge. Education is your first line of defense. Market volatility is another major challenge. Beginners might panic sell during dips, locking in losses. Security risks are also significant. Always do your own research. Dwyer. Section 4. Staking simplified, letting your crypto coins work for you. So, what exactly is staking? Let's break it down. Simply put, staking means holding funds in a cryptocurrency wallet to support the operations of a blockchain network. Think of it like earning interest in a traditional savings account. But instead of a bank, you're helping secure a network. Many cryptocurrencies use a proof-of-stake consensus mechanism. By staking your coins, you participate in this process. You validate transactions and help create new blocks. In return for staking your coins, you receive rewards. These rewards are usually paid in the same cryptocurrency you are staking. The amount you earn can vary based on several factors, like how much you stake, how long you stake for, and the specific rules of that blockchain network. Some networks offer higher annual percentage yields, or APYs. But remember, higher APYs can also mean higher risk. The passive part is that once you've staked your coins, they start earning rewards automatically. Minimal ongoing effort is needed from you. What are the pros of staking? It's relatively straightforward to get started. Many exchanges and wallets offer staking services. This makes it accessible even for beginners. It allows you to earn more crypto on your existing holdings. However, there are cons to consider. Your staked coins are often locked up for a period. Section 5. Beyond staking, exploring yield farming and crypto lending. Beyond staking, there are other popular methods. Yield farming is one, crypto lending is another. Let's look at yield farming first. This is a more complex strategy. It involves lending or staking your cryptocurrency in decentralized finance or DeFi protocols. In return, you earn rewards. These rewards can be in the form of more crypto tokens. Sometimes you earn the protocol's own governance token. Yield farmers often move their funds around, chasing the highest yields across different DeFi platforms. Yield farming can offer very high returns, sometimes significantly higher than staking. This is what attracts many people. However, it comes with much higher risks. Smart contract bugs are a major concern. If a DeFi protocol has a flaw in its code, hackers can exploit it. This can lead to a total loss of funds. Impermanent loss is another risk. This happens when you provide liquidity to a decentralized exchange. If the prices of the tokens in the pool change significantly, your share can be worth less than if you just held the tokens. Crypto lending is another avenue for passive income. It's more straightforward than yield farming. You lend out your cryptocurrencies to borrowers. In return, you earn interest. This can be done through centralized platforms or decentralized lending protocols. Centralized platforms act like intermediaries, matching lenders with borrowers. They often offer fixed interest rates. Decentralized protocols use smart contracts to automate the lending and borrowing process. The interest rates can be variable, fluctuating based on supply and demand. The pros of lending are clear: you earn interest on your idle crypto assets. Section 6. From pixels to profit, real stories of crypto passive income. It's always inspiring to hear success stories of real people who have made crypto passive income work for them. Let's consider Sarah. Sarah was a graphic designer curious about crypto. She started small, researched different proof-of-stake coins, and chose a few promising projects. She began staking her coins, investing only what she could afford to lose. Over time, her staked assets grew, and the coin values appreciated. Her passive income became a nice supplement to her design work. Then there's Mike. Mike was a software developer comfortable with technology. He explored DeFi and was drawn to yield farming. He knew the risks were higher, so he spent months learning and studying different protocols. He started with a small portion of his crypto portfolio and diversified across several farms. He actively managed his positions and didn't chase crazy APYs. He focused on more established DeFi platforms. His disciplined approach paid off, generating significant passive income, enough to reduce his work hours. These stories highlight a key point. Success wasn't accidental. It wasn't about getting lucky with a meme coin. Both Sarah and Mike were disciplined. They did their research, understood the risks, and started small. They didn't invest more than they could lose. Sarah chose a simpler strategy, staking, which matched her risk tolerance. Mike, with his tech background, tackled yield farming cautiously. Their approaches were different, but their principles were similar. Patience and continuous learning were vital. It's important to note these are illustrative examples. Results can vary wildly. Not everyone will achieve the same level of success. Some might even lose money. Section 7. Your Crypto Compass. Navigating with research and caution. We've explored crypto passive income, its allure, and debunked myths. Methods like staking, yield farming, and lending were discussed. Research and caution are your best friends. They are your compass in this wild crypto sea. Before investing, do your homework. Understand the project. Never invest more than you can afford to lose. Diversify to manage risk. Start small, learn, and adapt. Stay updated, follow reputable sources, and avoid hype. Building passive income takes time, patience, and discipline. Thanks for watching, and I'll see you in the next one.